Are the markets doing the job for the Fed?
There's some tail wagging the dog. And that does happen. It has happened before in slightly different guises. Central banks use forward guidance. So lower for longer was a form of forward guidance. They tried this higher for longer thing, but it's nonsense. It doesn't have any commitment device. It's fragile. It's falling apart. Yeah. So in answer to your question, the positioning, don't forget, is kind of bifurcated. It was fast money that was driving the big directional trades. So let's say hedge funds, CTAs, etc.
Right.
And it was real money that was sitting long. So in this rally in the bond market and drop in front-end yields, it's been, first of all, short covering because the world, well, the outlook has changed.
Yeah.
Certainly the world hasn't changed. The outlook has changed in line with a more reasonable view of the world. So first of all, short covering. And secondly, all the cash that's in money market funds, and we're talking trillions, those investors are fearing the opportunity cost. The opportunity cost of staying in a 3-month bill or a 6-month bill. Because when it comes to roll, the yield on the treasuries could be much lower.
Yeah.
So they're grabbing the 2s and the 3s and going up as high as 5, 7s and 10s.
Yeah.
And that should be pushing the coupon curve steeper over time. It's not at the moment. Yeah. Because in the early stages you get a parallel move, but when the cuts actually come, you can imagine the curve steepens. So that's the answer to your question. The positioning is a bit bifurcated. Yeah. So fast money, short covering, and cash flowing out of money markets into bonds. That's your marginal buyer of bonds. And to think, only a few months ago, people were saying on this show, I'm pretty sure people were saying, who's going to buy all those bonds? Because the predicament was you've got a strong economy, so no sign of recession, with a growing budget deficit, and that was a real problem for the bond market. Having those two things together is horrible for bonds. Yeah. If you've got a slowdown in the economy or even a recession, there's going to be no lack of buyers for bonds. So the whole equation's changed.
So give us then, very quickly, your 2024 call. What is the floor in yields? What is the Stephen Major call for the floor in the 10-year U.S. yield?
Our end 24 forecast is 3.0, and it's been there since the summer. We haven't moved it. Even when yields went to 5, we were obviously getting some heat when the yields went against us. But you don't change your forecast based on the spot. Yeah. But what you're seeing right now is a lot of forecasts, and therefore the consensus will have to come down because the spot's moved 100-odd basis points. So 3.0 is a reasonable number. That reflects, I think, equilibrium. So if the neutral rate is where the Fed says it is, then why would 10s be any higher than 3?
So then give us the other end of the range. What is the ceiling in yields for 2024?
Well, we're not going to get back to 5, and it's difficult to... There will be plenty of people that say, I want to buy at 420, 425. Well, in that case, I'll buy at 410. and that's how the psychology of the market has changed. It's buy on weakness. If you get any weakness, it's you know...
Are you giving me a 3 to 5% range?
No, I didn't. I don't think we can get back to 5. I think that it's difficult to get much above 4 already. 200 basis points is the average rally you get in 10s on every cycle. It's the average. So you're halfway. So to me, we've got halfway towards our forecast. We looked very uncomfortable 2 months ago, but suddenly it looks completely plausible, and you're saying it's not a big forecast.
Fair enough. Well, you know what? We're going to have you back in a couple of months, and we'll see how that stands. 3.94 on the 10-year yield right now. Stephen Major says somewhere between 3 and 4 in 2024 in the next 12 months. All right.